All right, let's jump right into this explainer. We're going to completely unravel the complex, sometimes dramatic, and honestly fascinating world of IRS audits, tax law, and how you can actually defend yourself. We'll be using a real-world scenario straight from our source material to break down the mechanics of the whole system, from how the government decides exactly who to investigate, all the way to how you can legally push back. Picture this. You're Bill, an economics professor, or Mercedes, a small business owner down in Tampa, Florida. It's just a normal afternoon. You open your mailbox, and boom, there's that dreaded envelope from the Internal Revenue Service, just staring back at you. It's a formal notice saying your joint tax return is under audit over a $5,000 deduction you claimed a couple of years back for mortgage refinancing points. I mean, even the most rule-abiding taxpayer feels a massive spike of anxiety in that moment, right? You immediately start wondering, do I have all my receipts? Was my CPA completely wrong? And most importantly, what's my actual financial exposure here? But here's a pretty wild statistic for you. Despite the widespread, almost universal fear of audits, currently, fewer than 1% of all tax returns are actually audited by the IRS. Basically, due to budget and resource constraints, they literally just cannot review the vast majority of returns. So naturally, the very first thing Bill and Mercedes are asking, and it's the exact same thing any of us would ask if we were in their shoes, is, why me? Out of millions and millions of returns, how did theirs end up in the crosshairs over one single deduction? Section 1, the dreaded audit notice, how the IRS chooses targets, and the clock on your return. The real secret sauce here is this mysterious DIF system, which stands for discriminant function. It's the absolute most important computer initiative the IRS uses to figure out who gets audited. It assigns this heavily guarded, algorithm-based probability score to every single tax return that comes in. Basically, a higher score means a much higher likelihood that the tax liability was underreported. For Bill and Mercedes, the specific amount or type of their deduction definitely generated a high DIF score, which flagged their return for a human to actually look at. The IRS also runs a document perfection program to catch simple math errors and an information matching program just to make sure the numbers you report perfectly match up with the W-2s and 1099s your employer and bank sent in. So just how far back can the IRS actually look? Well, the statute of limitations generally gives them a pretty strict 3-year window. But here is the absolutely critical detail. That 3-year clock starts from the later of the original due date or your actual filing date. So let's say you file an extension and finally submit your return on September 6th. The IRS now has 3 full years from that September date, not April 15th, to assess a deficiency. Now, if you happen to leave out more than 25% of your gross income, that clock instantly doubles to 6 years. And if you commit fraud, or just don't file at all, that statute of limitations stays open indefinitely. Okay, so let's say you do get audited. What does that actually look like? Well, because Bill and Mercedes have a very narrow, specific issue regarding one single $5,000 deduction, their CPA knows they're likely just going to face a correspondence examination. That's the most common type, and it's handled entirely by mail. Now, if Mercedes' business was more broadly under review, they might face an office examination at an actual IRS building. And then there's the absolute most dreaded one, the field examination. That happens right at your place of business, and it can drag on for months or even years. Moving on to Section 2, fighting back. The courts. What happens when you disagree with the IRS? Let's say our couple completely disagrees with the IRS agent's proposed adjustments, and they just can't reach an agreement at the Administrative Appeals Conference. They're going to receive a 90-day letter, which literally means they have 90 days to take their fight to the judicial system. And picking the right venue among these 3 trial courts is incredibly strategic. If Bill and Mercedes can't afford to pay the disputed tax up front, the U.S. tax court is literally their only option, and it's staffed entirely by tax experts. But if they're litigating a case that might be low on technical tax merit, but really high on emotional appeal, and they want a jury of their peers to hear their story, they have to pay the tax deficiency first and then sue the IRS for a refund in the U.S. District Court. Section 3, the Tax Law Rulebook, Understanding Primary versus Secondary Authorities. Look, to win in any of those courts, Bill and Mercedes' CPA can't just argue based on good intentions or feelings. She has to build a bulletproof defense using the actual official tax law rulebook. Understanding primary authorities is completely non-negotiable for tax professionals. You can only rely on primary authorities to formally defend a tax return position in a real dispute. Things like newsletters, textbooks, and professional journals, those are secondary authorities. They're awesome for helping you understand the law, but they hold practically zero weight when you're actually in a tax dispute. So looking at the hierarchy of these primary authorities, it's kind of like a pyramid. The U.S. Constitution and the Internal Revenue Code sit at the very top for the legislative branch, and they share the absolute highest authoritative weight with the U.S. Supreme Court over on the judicial side. Right below that, you have Treasury regulations, which represent the highest administrative authority, followed by more specific guidance like revenue rulings. When a CPA is building a defense, they want to anchor their argument as high up on this list as humanly possible. And if you think you can just bypass all this and use the internet, well, we've got a pretty hilarious cautionary tale from our sources. In an actual, real-life case, the tax court explicitly ruled against a taxpayer who tried to rely on internet research. The judge pointedly noted that the taxpayer's Harvard MBA in CPA training should have definitely taught him better, stating permanently for the official record that a quick Google search absolutely does not constitute reasonable cause to excuse an incorrect tax position. Section 4. The Art of Tax Research. Finding the right answers for Bill and Mercedes. So for skipping the quick Google searches, how does a CPA actually build a structured defense to save a client from a massive tax bill? A good CPA systematically follows these 5 distinct steps to formulate a rock-solid research memo. First, they gather the facts. Are they closed facts, meaning the transaction is already done and dusted, or open facts, meaning there's still time to plan and adjust? Then they pinpoint the exact issue at hand, locate the primary authorities, analyze any conflicting rules they find, and finally, document and communicate the results objectively. Bringing this right back to our case study, the entire fight between Bill and Mercedes and the IRS comes down to interpreting one single phrase in the Internal Revenue Code. Generally, the code says you have to amortize or spread out prepaid interest points over the entire life of the loan. But Section 461 G2 offers a sweet exception. You can deduct them immediately if the debt was incurred in connection with the purchase or improvement of a principal residence. So the $1 million, or rather the $5,000 question is, was there refinancing in connection with their original home purchase? And this is where it gets really interesting because the CPA found a direct, explicit conflict of law. The IRS's very own revenue ruling strictly says no. If you just refinance an existing mortgage without making improvements, you've got to amortize the points. But the Eighth Circuit Court of Appeals ruled in a case called Huntsman that if the refinancing was an integrated step to secure permanent financing, which is like replacing a short-term balloon loan, exactly what Bill and Mercedes did, then those points actually are immediately deductible. So the IRS says one thing, and a high-level court says the complete opposite. Section 5. Stakes, Rules, and Penalties. The consequences of getting it wrong. Now, here's the catch. Bill and Mercedes live down in Florida, which is in the 11th Circuit, not the 8th Circuit, where that really favorable court ruling just happened. So taking the 8th Circuit's position on their return carries some genuine risk. This brings us to substantial authority, which is the key threshold here. Neither the taxpayer nor their CPA will face an underpayment penalty from the IRS as long as their position is backed by substantial authority. In the tax world, this basically translates to having roughly a 35 to 40% chance, or better, of winning if the issue goes to court. Because Bill and Mercedes' situation mirrors that Huntsman case so closely, their CPA determined they absolutely meet this threshold. They might still owe the actual tax and standard interest if they lose, but they are fully protected from punitive penalties. And trust me, avoiding penalties is a massive deal here. While our couple is perfectly safe because their CPA put in the work to find substantial authority, taxpayers who get this wrong face severe consequences. Outright negligence or taking totally unreasonable positions brings heavy civil penalties, which often slap an extra 20% right on top of the tax you already owe. And if a taxpayer crosses the line into willful intent to defraud the government, actual tax evasion, they're looking at criminal penalties. These require a higher burden of proof to stick, but they come with massive fines and real prison time, exactly like the notorious mobster Al Capone faced when the IRS finally caught up with him. So as we wrap up this explainer, I want you to take a second and think about your own financial setup. Whether you use a high-end CPA or you file it all yourself, the rules of the game are exactly the same. Between those mysterious DIF scores, the massive primary rulebook, and those strict penalty standards, being prepared is literally your only real defense. If that dreaded IRS envelope arrived in your mailbox tomorrow, are you completely confident your deductions are backed by substantial authority? It's definitely a question worth finding the answer to, long before that clock starts ticking.